Okay, good afternoon, everyone, and welcome to this session. My name is Joanna Garzon. I am going to be the chair of this session. It is my pleasure to introduce you Mr. Nikita Kosodoi. He is going to present us his paper titled Active Learning for Reject Inference in Credit Scoring. Nikita is a PhD student at Humboldt University of Berlin. He holds a Master in Science degree in Economics and Management Science from the Humboldt University in Berlin. Since April 2018, he works as a researcher at the Chair of Information Systems. In the course of his PhD, Nikita researched machine learning and deep learning applications in credit risk analytics. So thank you so much, and over to you, Nikita.
Thank you very much for the introduction. Very happy to be here and to be able to present our work in progress on active learning for reject inference in credit scoring. So I will start by talking about the problem, which is the sampling bias in the credit scoring. We'll talk a little bit about where the sampling bias comes from and what impact it has on the scoring models. And then I will talk about different ways of correcting this sampling bias with what is called traditional reject inference techniques, and about how we try to do this with active learning. And then I will move on to some preliminary empirical results that we have gathered so far on the potential of this approach. So let me just start with explaining the problem and illustrating the sampling bias. Most of you, I'm sure, are very much familiar with the standard binary classification credit scoring setup, where we as a financial institution have a scoring model that observes the features of incoming applicants and predicts the probability of default. And then we use these predictions of the scoring model to accept or reject the customers based on the predicted scores. The problem with this approach that we only eventually learn the actual repayment outcome and the label for the customers that were accepted by the financial institution. So if the customer repays the loan, we label them as good. If they do not do it timely, we label them as bad risks. And then we use the training data that contains such applications to train and update our scoring model. But the problem is that we never observe the labels of the customers we reject. And therefore, the training data that we have becomes not representative of the overall population of potential borrowers that come in asking for a loan. And these labels are missing not completely at random, but they're missing depending on the features of the applicants, depending on whether the model decided to accept or reject them in the past. And this creates sampling bias. Now, the magnitude and the adverse effect of this sampling bias depends exactly on the missiness type. Like if we, as a scoring model, if we have a standard parametric model like logistic regression, and we only observe a slice of the training data, it might be fine to stick if the data is missing at random and we are not able to observe the full distribution. But if the data is missing not at random, in other words, if our acceptance policy is not stable in time and there are big changes, for example, with the data that is supplied by different providers, or if we have overriding procedures where a credit officer overrides decisions of a scoring model based on some other attributes not seen to the scorecard, then we might have a much bigger problem. And what does it mean, the problem? What is the adverse impact of sampling bias? Let me just illustrate this using a synthetic data set. So here we are simply sampling some good and bad risks from multivariate Gaussian distributions, as you can see on the scatter plot on the slide. And we simulate this acceptance loop that I was just showing you on the previous slide by iteratively generating batches of new applications, and then using a scoring model to accept and reject them, and then learning labels of accepts only and updating the model. So if we run this iterative process for a certain number of iterations, what we start seeing is that there is a sampling bias, and the data distribution starts to diverge between what you see on the accepted applicants, which is a green area here, and the rejected applicants, which is an orange area here. This is just a difference in the distribution densities over one of the synthetic features. And this difference is the sampling bias you see in the data. And what does it mean for the scoring model? Well, if you track performance of a scorecard in time over this acceptance loop iterations, and here we are simply using area under the learning curve, area under the ROC curve as a performance metric, which is a popular evaluation measure in credit scoring. And we compare performance of the base model, which is a green line here, trained on a biased set of accepts, and the oracle model, which is an theoretical upper performance bound, which is a model trained on both accepts and rejects, so therefore does not suffer from the sampling bias. We see that there is a gap between the performance of these two models, and this gap remains large over the acceptance loop iterations. And this gap is exactly the model performance loss due to sampling bias, because the model is the same, but the underlying training sample is different. For the base model, you have a biased set of accepts. For the oracle model, you have a whole population of applicants, accepts plus rejects. So as a financial institution, we would like to try to bring this green curve upwards as high as we can in order to mitigate this performance loss due to sampling bias. And then the question is how we do that. So that's what methods that look at sampling bias correction try to answer in credit scoring and in other areas in general. In credit scoring, the literature has been focusing on the family of methods that is commonly referred to as reject inference. So reject inference is simply refers to different techniques that mitigate this bias by using data on rejected applications. These techniques work in a different manner, but most of them operate by labeling rejects using some kind of an approach and then adding these labeled rejects to the training data so that the data is more representative and can now be used to train a better scoring model. Some techniques work differently without directly labeling the rejected cases, but still use some kind of approach to extract information from the rejected applicants. And some common applicants of such techniques may include methods like hard cutoff augmentation and parceling. I will not go into a lot of detail, maybe just to give you one example about hard cutoff augmentation. This is basically a simple technique that uses a scoring model that is trained over the accepted applicants and then predicts the probability of default for rejects. And then based on these predictions and using a certain probability threshold, we can label them as good and bad, and then add them back to the training data so that it is more representative and hopefully helps us to train a better scoring model on that kind of data. Now, the problem with this traditional reject inference techniques is that they are what you can call offline. And by offline, I mean that they work with the previous reject cases. So these are the cases that were previously rejected by our scoring model. They could come from a couple of months ago, they could come from a year ago, and there is no reliable way to actually learn their labels anymore. These cases have already been rejected. We just label them, hoping to do it as accurately as possible, and rely on that as an assumption. This is a limitation of this traditional reject inference techniques, but there are others as well. For example, due to this time delay between the moment where we have the rejected cases and today, if the data experiences a certain data set shift, like due to the business cycle or due to other external events like pandemic crisis and many other examples, it may be that the rejected cases we work with are not that much relevant anymore for the target population of borrowers which will come asking for a loan in the next months. And if these rejects are too old, then the potential amount of useful information that can be extracted from them is limited, depending on the magnitude of the data set shift. And finally, another potential limitation is that there is a regulation that may actually prohibit using data on customers that were previously rejected. For example, in Europe, we have GDPR that has some limitations on for how long and to what extent we can keep information and data on the customers that are not actually our customers. And since we are talking about rejected clients, they're not customers anymore. So this regulations can prohibit to some extent the use of such data. So trying to some extent mitigate these limitations and to look at this problem from a different angle, we are focusing on what I will refer to here as online reject inference with active learning. So instead of working with the previous rejects, we will actually be working with the applications that are about to be rejected by a scorecard. So a customer comes in, our scorecard predicts that the customer is high risk, so they shouldn't get a loan. But instead of rejecting them immediately, we will also try to actually assign the loan, to issue the loan to some of these customers who are about to be rejected, to learn the actual labels of such cases. And if you think about this through the lens of the sampling bias, ideally, of course, you would like to give loans to everyone, every person who comes in, because then the data that you gather will be fully representative of the potential population of the population of potential borrowers. But of course, this is costly, and this is why we have credit scorecards in place, right? Because issuing loans to customers that are more risky is likely to bring us monetary losses, since not all of them are going to repay the loan back. So this is why looking at this cost-benefit trade-off, where the cost comes from issuing loans to risky customers, and the gain comes from having more representative training data and training a better model on this training data. This trade-off is important to keep in mind here. And this emphasizes the question, what are these rejected cases that we are going to actually label, that we are going to issue a loan to? This is where active learning may be helpful. And to give you just a quick background on active learning is essentially a framework where you have a learning algorithm that queries to label the data points that are currently unlabeled. That essentially tells which data points are more interesting, so to say. So if you consider a classification task where you have labeled and unlabeled data, like in credit scoring, labeled are accepts and unlabeled are rejects, what active learning does is that it identifies unlabeled cases that are deemed useful. And by useful, what useful means, the definition of this depends a lot on what exact active learning technique you are using here. Essentially, you are trying to answer a question: which observation would improve the performance of my classifier, of my scoring model, if I knew the label of this observation? And this can be measured in different ways, like uncertainty, expected error decrease, and others. It depends on the exact method. But it is important to note that within active learning, you are not actually labeling the cases using an active learning method. The goal of active learning is just to identify interesting cases. And then the active learning pipeline assumes that there is an oracle, which is a human expert or some kind of mechanism where you can actually learn the labels of these cases. And then you can append these labeled cases to a labeled data and train the improved classifier. So that's how active learning works in general. And in our case, in the credit scoring context, what it actually means is that in the acceptance loop that you saw before, we are simply integrating an additional model. So we still have a scoring model in place that filters the incoming applicants and decides whether they need to accept and reject them. But we also have a second component, which is an active learning model, which then looks at the rejects, at their futures, and at the predictions of the scoring model for this reject, and then decides if this reject should indeed be rejected, or if we actually should accept this person because this application is useful in terms of its potential impact on our scoring model. That's how our acceptance loop changes. In the project that we are currently working on, we are considering a set of active learning techniques, which are one of the most established and popular in the field. I will not go into a lot of detail describing how they work exactly, but just to give you a rough understanding about main intuition behind how these techniques work here, I will explain you the main ideas. So we look at 3 active learning methods here. One is uncertainty sampling, which is essentially a method that selects observations where the machine learning model is least confident about the label. So in our case, it means that the scoring model predicts the probability of default very close to 0.5. So it is not very sure whether the customer is actually good or bad risk. So in that case, uncertainty sampling would say we need to label such kind of applications in order for our model to become more sure on such observations in the future and be more accurate with that regard. Another method we look at is query by committee, which looks at it from a slightly different angle. So instead of a single model, you have a set or a committee of scoring models, for example, trained on different training faults. And then we look at the loan applications where our scoring models, our variants of scoring models would disagree the most. So instead of looking at a prediction of one model, we look at variants of predictions across different models. And if there are many models that disagree on the label, this is a sign that we should label this observation. In other words, we should assign the loan to this customer in order to be more accurate about such observations in the future. And finally, we also have an optimized probabilistic active learning, or OPAL, where basically the main idea is to look at observations that can maximize the expected reduction in the misclassification cost. And this misclassification cost can be asymmetric, which is crucial for domains like credit scoring, because we have different error costs from rejecting a good customer and accepting a bad customer, and a possibility to account for that is also important to make sure that we are looking for the potential observations where we might have higher error costs, in the areas of the distribution where we might have higher error costs. Right. So this is the set of techniques that we look at here. And now let me move on to some of the preliminary empirical results that we have on the active learning for reject inference. So in our project, we currently work with 2 data sets. With the first data is a real credit scoring data set, one of these well-known data sets in the Community Lending Club, which is a consumer peer-to-peer lending platform. The one thing to note about this data set is that the actual repayment behavior of rejects is not available, right? The data is only limited to the loan applications that were accepted, and then we knew whether the loan was repaid. For rejects, we don't know the actual labels. So in order to be able to perform the analysis on this data, we are using a scoring model to score the applications in the data set and then treat the most risky accepts as rejects. This is not ideal, but this allows us to perform the analysis. And since this is not ideal, we also perform experiments on a synthetic data set where we have full control over the data generation process and where we can therefore see the repayment behavior of both accepted and rejected applicants. So we are using the same technique, generating data from multivariate Gaussian distributions, as I was describing in the beginning of the presentation, to construct the synthetic data set with 2 classes of loans, good and bad. The important thing to note here about the data set, as you can see from the table, the bad rate, it differs a lot between the Lending Club data and synthetic data that we set up. This will be very important for the in terms of the impact on the empirical results, and you will see that in a few slides. On both of these data sets, we run the acceptance loop that I was talking about previously, where we iteratively generate or draw a batch of new loan applications, and then we decide which applications to accept. So here in our experiment, we accept 20% customers that predicted as least risky by our scoring model, by our ML model. And in addition to that, we also select 10% cases selected by an active learning model. So the cases that active learning model thinks that they are most useful for improving the performance of our ML model. Now, we essentially run this iterative process for 200 iterations and evaluate performance of the scoring model on a holdout sample. And for performance evaluation, as I was telling earlier, there are two important components. We look at the model performance. So how much is the accuracy improving compared to the base model that doesn't use rejects, and how much does the data augmentation cost? So what is the cost or benefit of accepting this extra 10% applications with an active learning model? So on this slide, you will see the results for the Lending Club data in terms of the model performance. So you see the same learning curve format as I was showing you in the beginning of the presentation, with AUC on the vertical axis and acceptance loop iteration on the horizontal axis. So we still have two lines here. The green line is a base model. So just using a scoring model trained on accepts without active learning. And we also have a blue line that represents the Oracle model. So the model that uses both accepts and rejects in the training data. And this difference between these two curves still represents the loss due to sampling bias. But now, in addition to these two models, we have some extra techniques that you can see in between those curves. So first of all, we have offline reject inference techniques here, hard cutoff augmentation and parceling. You can see that hard cutoff augmentation does roughly at the same level as the base model, and the parceling only improves the performance in the first maybe 30 iterations, but doesn't do a very good job in the following iterations. Now, if you look at the online, so at the active learning based reject inference, you see that all these lines come in between the Oracle and the base model, meaning that they mitigate some of this loss due to sampling bias. The most prominent method here is the one labeled with a black line here, so query by committee, because you see that it consistently outperforms the other active learning techniques, including the random benchmark. The random benchmark is let's accept 10% random applicants out of the rejected applicants, and this proves to be quite a strong benchmark in the active learning field that you need to beat in order to make your selection strategy more smart. So you essentially see here that there is some gain from active learning for every one of these methods compared to the base model, which is not using any data on the rejects. This is in terms of AUC. You might be wondering, is there a gain in other evaluation metrics or also on the other synthetic data set? And this is what you can see in this table, where we quantify gains in terms of AUC, Breyer score, which is a calibration quality evaluation metric, and ABR, which is bad rate among accepts. So in this table, we measure numbers relative to the base model. So relative to this green line, what is the area under the learning curve in which the active learning method outperforms the base model. So positive numbers indicate that there is an improvement. And what we see here in terms of the results is that query by committee does the best job in AUC, whereas uncertainty sampling is doing a better job in terms of the Breyer score, so in terms of the calibration ability. But essentially, you see also that all numbers are positive, meaning that there is a positive model performance gain from active learning. Now, this is model performance, right? But you also have a second component, the data augmentation cost. So in order to compare these two numbers, you need to measure them on the same scale. So we convert these performance gains into the monetary gains, measuring the profit per euro issued. And this is what we do in this table, where we have data profit, data augmentation cost, model profit, model performance gains, and total profit, which is simply a sum of the two. And what you see here, for example, for Oracle, is that there is a positive model profit, but a negative data augmentation profit, because the issuing loans to all rejected customers costs money, but in the total profit is also negative. And if you compare these numbers for all active learning techniques, you will see that Query by Committee does the best job overall, but you will also see that on synthetic data set, the data acquisition, the data augmentation cost still outweigh the model profit, the model performance gain. So the total profit is actually negative, meaning that compared to the base model, the performance, the gains from active learning are here negative compared to the Lending Club data sets, where the gains are positive. And this is what is observed because of the difference in the bad rate among the data sets. On Lending Club data, where the bad rate is rather small, the data augmentation cost is not substantial. Whereas on the synthetic data set, where the bad rate is high, you see that there is a data augmentation cost that outweighs the model profit. Right. So this is everything in terms of the results I was going to show you. This is a short summary of the talk. If you are interested, and since I have the time limitation, I will now stop with my talk, and will be happy to answer any of your questions and clarify some of the things that might not be understood from my fast talking in the last few slides. Thank you.
Thank you so much, Nikita, and thank you so much for this wonderful presentation. Yes, indeed, you have quite a lot of questions, so let's start. How did you incorporate not taking up inference, where you infer the performance of those who were accepted but did not take up the offer? They will have lower risk than the rejects.
Right. In our experiments right now, we don't have such cases, so it is fair to say that we ignore such cases. We assume that the accepts are the people who then agree to the offer and take up the loan. In practice, yes, of course, you will have such cases as well. They will be coming from a certain part of the data distribution that you also want to look at. And then you're not really able to solve this problem with our technique, because our technique will say, okay, let's give them the loan, but if they don't agree, if they don't take up the offer, we cannot really do anything about that. We can use traditional reject inference techniques to assign pseudo labels to such cases, but we cannot really force people to take up the loan and see if they repay this back. So I would hope that this part of the data distribution can be covered with other applicants who are actually rejected, but also come from a similar region of the data distribution.
Okay, thank you for that. Another question: how would you explain to a financial conduct authority that you are essentially using some clients as guinea pigs for improving your future model, while those clients may end up having payment problems?
Yes, this is a very good question. I haven't really talked about the ethical side of this from the statistical, but this is what we want to do from the statistical point of view. But of course, regulation and ethics and our own values as a financial institution might prohibit us from using such strategy and just, issuing loans to people without scoring and then forcing them into payment problems. What we can try to do about that is that we can, when doing active learning, we can focus on a specific subset of the feature space of the rejects, where we don't want to give loans to people who are very, very risky and are likely to run into these payment problems and can have issues because of that in their following credit history and life in general, but focusing on the cases that are closer to the decision boundary, that are maybe in between accept and reject, as with uncertainty sampling, for example, where the model is unsure whether it's good or bad risk. And we can still issue them alone, being less worried about the fact that they might have this serious issues. But that, of course, still requires some further third and analysis regarding the potential problems with regulations.
Yes, we have two comments that agree with that. One comment says, I will say the major risk in using this online approach is in regard to responsible lending, and regulators may ask why we approve customers that will clearly struggle to pay the credit back. And another comment is that this is an ethical element to consider in accepting applicants who cannot afford to repay the loan. So yeah, clearly there is a ethical issue in what you already covered. There is another comment here. Offline reject inference has certain sanity checks, like a ratio of non-bad rate to infer bad rate. Do you monitor those online as well?
Right. So you could do that. This is not what we currently do, but I think you could also incorporate such sanity checks within the active learning technique to make sure that first, active learning method says that we should label these customers, but second, do these customers also pass a certain sanity checks to be sure that that nothing weird is happening there. But since also we learn the actual label not from the active learning technique but from the customer itself, maybe there is less need for such sanity checks in here.
Okay. Another question. Did you consider privacy issue when applying online strategy?
I'm not sure what is meant exactly here by the privacy issue. If this refers to what the previous questions were also asking about the ethical side of this, and about maybe the fact that people learn that others who are not that high on the credit score receive the loan, whereas the others would not. We haven't really considered that so far. This remains a problem, and as I said, maybe the only solution that comes to my mind for now is to limit the space of the potential rejects that go for labeling to cases that are less risky. If something else is meant by privacy, I'm happy to talk about that more.
Okay. Another comment say, I assume uncertainty sampling, as noted in slide 18, would overcome any conduct issues. Yes, again.
Right. So let me quickly go back to uncertainty sampling. Right. So uncertainty sampling is here fully reliable on the initial scoring model that is trained over accepts. And yes, because of that, you may have some issues, since if the scoring model trained on accepts is biased and does not thinks that certain distribution areas are high risk or low risk, you may have what is called in active learning a so-called self-lock-in problem, where you don't explore this distribution region. So you might suffer from these issues, and you might use other active learning methods to try to solve these issues.
Okay, and I think I will go for just two more questions because time is coming to the end. So in slide 23, calculate based on no good and bad customer, or it is calculated on the whole database used for the model development?
Right, so in this case, we have a holdout sample that is representative, because on synthetic data, we just take a holdout sample from the overall population of borrowers. In Lending Club data sets, since I was telling that we consider the most risky accepts as rejects, we also take a holdout sample that contains a certain proportion of accepts and rejects. So it is also representative of what we refer to as the population of borrowers. So this should be a data representative of the population.
Okay, and he say it is normal to have such a big difference, since you are using the rejected customers and they are usually in his majority in the lower score points.
Yes. Since performance is not computed on accepts only, but on accepts plus rejects, where if we have, let's say, 20% acceptance rate, we have much more rejects, then it's the potential rejects that influence the model performance more. But this is why we have other performance metrics like ABR, bad rate among top 20% accepted customers, that only looks at the top quintile of the least risky customers.
All right, Nikita, thank you so much for such a wonderful presentation. I am afraid I couldn't cover all the questions that you received. You received quite a lot, so, which is great. And I invite all those who asked questions and we couldn't cover to contact Nikita directly in the networking area in the platform. And I stop here this presentation, and thank you very much indeed for all of you to be this afternoon with us, and I invite you to come back to our portal. Thank you and good afternoon.
Thanks a lot from my side as well. And after the kind of conference, you can also contact me using this contact information on the slide, or get the PDF of my slides using this QR code. Thanks.
Thank you, Nikita. Goodbye.